Hello, friends. Today I am updating my price on Alphabet, ticker symbol GOOGL. I This is one of the first stocks that I talked about. I haven't updated the price, and that's what I would like to do today. Also, what I would like to do is, as I'm updating you, I also want to update you on the new form. I'll be pointing out some things that I just made on my new Excel sheet that you can find at buymeacoffee.com, and the link is down in the description. I just want to let you guys know what I've been working on, and let's just jump right into Alphabet first. Right now, the price is at $140.52. In the last 5 days is down 5%. The last month is flat. Year to date is up 1.4%. And then the last year, it has grown an amazing 48%. I owned a little bit of it. I bought it somewhere around 90, and I will like to enter the position again. So that's why also I want to update that. The price that a lot of analysts are thinking in the next 12 months is $150.68, which will be an upside of about 7.2%. P ratio right now is at 24, with a forward PE of 20 times earnings. They reported last January 30th, and when they reported, they beat on pretty much everything. In revenue, they beat by almost $1 billion, more than $1 billion. They also beat on normalized and GAAP GP. No, what is it? EPS for almost 4 cents each. And right now, the next earnings will be on February. No, that's April 25th. Somewhere around there. They are actually estimating lower EPS, and at the same time that they're estimating less revenue. There has been 17 revisions in the past 90 days, and 30 revisions in the last 90 days. And as you can see, their earnings, quarterly earnings, have been growing pretty nicely. And one of the things that I notice is a lot of people are freaking out because there has been a lot of conversations about other companies using AI to do a better searching. There's a competition from Microsoft, from Meta, are trying to work on those things. So that has created a speculation that Google may be having a problem with, or is going to be having some competition. Also, I think that there is a lot of talk about whether the ad revenue business generally, but including Google, is going to be suffer because a little bit of a recession. I don't know. I don't think so. I think that they're probably going to beat estimates again. So if I have not listened to the call, so I will encourage you, if you are investing on Google, to listen to the call. You can go to Quarter app and listen to the call, or just read the latest quarterly review. And this is my new updated valuation sheet. As you can see, in the last 5 years, the revenue has been growing by about, the revenue per share has been growing about somewhere 16%, and in the last 10 years, about 17.5%. And the two numbers that I have here is that those are, and the reason why I'm going to take a little bit of time in explaining some of these things is because some of you have been asking me, hey, I'm a new investor. I just want to learn a little bit more. So I'm just going to take the time to tell you a little bit about this. I probably will make a video eventually getting a little more into details. But so the revenue per share growth includes the repurchases of shares. As shares are purchased, the number of shares go down, and then there is it influences the average growth on the per share revenue. The revenue has organically been growing, or well, organically no, but they have been growing at a 13.7%. But because of the buybacks, it inflates that number to almost 16%. In the last 10 years, it has been growing at 16.6%, but because of the buyback, it kind of makes it a little bit inflated to 17.5%. And that is part of the problem of using per share numbers. I am using per share numbers normally because I buy shares. I know that there is a philosophy over there that you should just evaluate the company on the raw numbers, and then after you do all that, then you jump into the per shares. But then these videos will be super, super long, and this is how I decided to do it because there's not too much difference. I mean, I want to account for the shares that are already being purchased. I don't want to calculate that later. I included this gross margin. I've been listening to watching a lot of videos about a fabulous investor. His name is Terry Smith. And one of the numbers that he looks at is the gross margins. And he looks for his company so the average gross margin on companies in Wall Street are somewhere around 45% gross margins. So he looks for above average. And the reason why I'm doing all this research and I've been rethinking a lot of the things is because I have been a value investor for a while, and I've been burned a little bit by a couple of companies because they're value traps. So what I'm starting to think about is I'm going to try to look for first quality companies. That doesn't mean that I will not evaluate and make videos of companies that I don't think they're quality. But for my own investing, I'm going to be moving more into quality investings that I am confident on. And I really like this explanation by Terry Smith that says that if you find companies of above 60% or close to that, 50 to 60%, that means that when there is a recession, they have margins, they can absorb a shock of inflation or issues with their margins. So I kind of like that. When it comes to earnings per share, which is after we deduct everything, this is pretty much the money that is left. This is the net profit that they make for Alphabet. It's been growing per share at 18.7% in the last 5 years and 18.9% pretty much on the last 10 years. And this is another number that Terry Smith uses. He uses operating profit margin. I like to use profit margins, and I'm always looking for somewhere close to 25% or above. So these profit margins from Google's are pretty good. That tells you that it's a quality company, and the average stock out there has a profit margin somewhere around 15%. So we're looking for something a little bit higher. And free cash flow has been growing pretty nice for the last 5 years. This is almost 20% 5 years, and consistently almost 20%, a little bit above 20% in the last 10 years. Free cash flow margins average in the past 5 years is 22.6. And once again, I am looking also for somewhere around 25%. 25 is good, and above 25 is amazing. And the average, if you want to know, is 15% out there. So this is something that I'm learning from Terry Smith. I never thought about it, is to think about as a free cash flow yield. Google gives you a free cash flow yield um, in average in the past 5 years of 3.61%. And I will be talking a little bit more that once I get to the summary. So just stay around, and if you're liking the content so far, please just like and subscribe, and leave me a note down there. Let me know how I'm doing. If you have any additional questions or um, anything like that. We're moving into um, book value per share. Book value per share is been growing nicely in the last 5 years for 9%, and in the last 10 years for 11.2%. Return on invested equity is at 23.5%. I look for numbers, return of invested equity of above 15. Now, interesting, when I was listening to Terry Smith, he looks for above 25%. So I was being a little more conservative on that. The average is 15%. So that is very interesting to me, and I don't know how I feel for that. He actually, he's concerned more about the ROEC, which is the return on investment capital, to be above 15% or close to 15%. Return on invested, return on equity, that includes debt. That doesn't count for debt, so sometimes that number is inflated because they're able to produce more money without including the debt, because they're using the debt. And then return on asset, I normally look somewhere around 5%. That's because of the average. And I heard the 5% on the book called The Little Book That Beats the Market. They tend to look for companies with an return on assets of above 5%. When it comes to dividends, Google doesn't have any dividends. But when it comes to debt, it is very good that even though it has been growing in the past 10 to 5 years have been growing, they are able to pay their whole long-term debt with the if we take the average of the free cash flow in less than a year, in half a year. So if they wanted to pay off all their long-term right now debt, they could just pay it. So that's great financial situation on the sheet, on their balance sheet. That is great. When it comes to shares, as you can see, they were issuing shares from 2014 to 2018, and then since 2019, and they have been buying back shares, and that's why you will notice that the 10-year average, the CAGR buyback is at 0.77, while in the 5 years it's almost at 2%, so 1.93%. And some of you guys have asked me, why do I look at outstanding shares? That's kind of pretty cool. Okay, is that kind of important? Well, let me just put it like this. For me, a wonderful company is a company that is buying shares above, at an average of above 2.5%. Why? Because 2.5% in where's my numbers? Actually, let me just do it here. Let me just bring here 2.5% times 5 years, which is where I normally try to look to hold a position, a little bit 5. That gives me just right there. If they don't change their earnings, if they don't grow their revenue, if they don't grow anything, they're growing everything by they're returning to me 12.5% of my investment. Now that is in 5 years, so it's not as much, but my revenue will grow at the end 12.5% since then. If it's 2%, then now we're talking about 5%. 10%, and if it's 1.5% of buybacks, it will be 7.5. So that's kind of how I look at it. The average, I think, most good companies, they buy somewhere around 1.5 to 2% back. So above 2.5, that's pretty good. When it comes to summary, this is a new page that I just made. It's just, I was doing it on the side, and I just figure I'm just gonna make it all in one page. It helps me a lot, and then it probably helps you just kind of whenever I'm doing summaries. You can see all the numbers right here. You can pause the video and look at them. Let me just explain a little bit the colors. When you see kind of a yellowish number over here, that just means that it's a wonderful number. It's above 15% for me. Green means great, which is above. It's above average. Blue is average or good. It's a good company. It's a good number. I don't have it here. Actually, yeah, I have it here. It's like an orangey. That is below average, and red, which you might see in one of the videos coming up, is just not good. This is a risk. This is a warning. Okay. So as you can see, you're not gonna find the perfect company. Every company is gonna have some things, but Google is doing very, very good. When it comes to the yield, the free cash flow yield, in the last 10 years, the average is 3.42%, and in the last 5 years, 3.61%. What is free cash flow yield? Maybe this is the first time that you hear it, and it was the first time that I heard when I was listening to Terry Smith. So the idea between the yield is the math is very simple. So what we do is we take the free cash flow per share, which will be, in this case, 5.55, and we divide it. Now there's two kind of schools on this. You can either, or thoughts, you can either just divide it by the stock price, or you can then take, which is a little bit more complicated, taking the enterprise value. I'm going to just make it simple. I'm going to use the price that is going on right now of the stock, and that gives me times 100. That gives me a 3.94% yield, which means if Google was a CD, or it was a bond, and it didn't grow, and right now I will be receiving in free cash flow close to 4%. That is a really good number, especially now. Probably doesn't sound very good because a lot of U.S. bonds are at 5%. But the reason why this is good is because this stocks, this will be kind of the basic stuff where you're starting. You're starting at a 5%, a 4% yield with Google. But as we know, as we've been looking here, the free cash flow has been growing almost 20% in the last 10 years, or 20% in the last 5 years, which means, and I know I'm talking a little bit too much, but I do want you to understand this. What it means is this. If we take the rule of 72 and we divide, I think it's 72 divided by 20, it means that in 3.2 years, if it continues to grow this way, the free cash flow will double. So if we do 5.55 times 2, divide it by 140, what was it? 52. That means that in almost 4 years, my free cash flow yield will go up to 7.9%. And this is part of the reason, so that you guys know, whenever the free cash, the bond yield goes up, that's part of the reason. That's one of the reasons why stocks go down. So this is a good number to pay attention to. And I'm gonna be referring to that in some of my videos, probably not going as in detail as we just did today. When it comes to the multiple, now we're jumping into valuations. So I have to give you my disclaimer. I am not a financial advisor. This is for educational purposes only, and I am not responsible for your gains or your loss. Okay? So do your own research. Now, when we use the historical multiple valuation, this is, you have seen it before. What it does is it takes all the values per share. I do a 5-year average, and that's because, things go up and down. And then multiply it by the the medium of the PE or price to sell, the multiples, and I multiply it by them, and it gives me a historical multiple valuation. It gives me a price that historically the company has been valued at. This is how the market has valued Google. So it's right now the fair value is $140. So you could say, based on only this valuation, that Google is selling right now at a fair value. Now, I like to do this kind of multiple valuations more in the historical sense instead of comparing it to other companies, because each company is different. Now, this is a new evaluation that I am adding. This is what I call revenue-based valuation. But if you follow a YouTuber called Patient Investor, this is where I saw how he evaluates his companies. I will leave the link in the description. I want to give him the credit for that. So what we're doing is we're taking the revenue, we are growing it at the normal growth rate of the whole revenue company for 5 years. Then we're taking the profit margin out of that. Then we also are assuming that that Google will continue to buy back 1.93% of their shares. So whenever we divide the net income with the shares, it gives us a future EPS number, which that will be, or earnings per share, that will be $11.34. The average PE in the last 5 years is 25. I'm going to use that just to be conservative. And that gives me a number of $283.51. Normally, if Google was adding dividends, I will be adding all the dividends that we will collect by then. And then, just like him and just like me, we both like to receive 15% in our investment. Why? Because 15%, if CAGR, it doubles every 5 years. So what I'm doing is asking, or what he also is doing is he's asking the question, what price do I need to buy it today with this assumption so that it will double in 5 years whenever I sell the company and I receive all the dividends? And that price will be $141.75. That will be the fair value with no margin of safety. Okay? So that's one of the new valuations that I have. This one, you have seen it before, is discounted earning valuations, in which we grow the earnings per share for 5 years. We multiply it by a PE. Then we have a future valuation, and then just like we did with the other one, we discount it back to 15% because it's the rate of return that I desire. So that will be just divided by 2, and it gives me this. It gives me trading 12 months of $159, and if we take the average, it will be $124. Payback time is we're kind of just collecting all the free cash flow, and we're growing it at 17%. which is what Google has been growing their free cash flow. If we were to collect all of those for 8 years, that would be $200 using the trailing 12 months initial number. And if we use the average, it will be $160, which will be fair. I also included discounted free cash flow valuations. After listening to a lot of people, I thought that this is one of those important valuations that I have to add. So I'm not going to get too much into how it works because we're already at 25 minutes. And thank you for continuing to listen to me. But pretty much what we're doing is we're growing the free cash flows at 17%. Then we're discounting all the values. Then we are assuming that in 5 years we sell the company, and then we receive that money. That money is going to be discounted and we're going to be using a multiple at the end, and I'm using a free cash flow multiple, and I'm using the medium free cash flow per share, free cash flow multiple for Google. And it gives me, once I add all the stuff, it gives me a value somewhere between $200 and $158 fair value today. Owners earnings valuation. This is a valuation from Warren Buffett. I got this one from Phil Town. He has a couple of books in which he talks about them. The main one that I took it from is called Invested. It's a book that he co-wrote with his daughter, and they explain this formula that they got from Warren Buffett. And now I don't think that it's not all valuations are good for all companies. So this company, Google, will not be a good one to use earnings valuations. That's why I have ignored it. So whenever we put everything together, we're looking at an average fair value for Google of $154. And we put a margin of safety. Because Google is so good, I am willing to just put a 10 to 15% margin of safety. So if we put a 15%, we're looking at somewhere between $130 to $143. Now, I want you to understand this. I know I've talked for too long, but I want you to understand this. If you buy with no margin of safety, remember, I already put a 15% discount rate on most of these evaluations. That's why you will see that some of my numbers are lower than other YouTubers because they use a 12.5% or they use a 10% discount rate. I use a 15%, which makes all these numbers lower. So that's why you might see another YouTuber put a 30% or a 20% margin of safety, and I am confident enough with Google to just put 15% or even a 10%, which will be an average of a good price right now. Now, even if you just buy it at 154, that will mean that you will be receiving, based on our assumptions, of course, that Google will continue to grow, and you will be getting a free cash flow of, I think it was $5.55, growing at 20% per year. Those are the assumptions that we have, which will be a free cash flow yield right now of, what was it? Divided by 2 of almost 4%, and it will grow to almost 8% in the next 3.5 years. So anyway, I've talked enough. I thank you for listening. I hope that you enjoy my description. Please remember to subscribe, leave a note and a like. Let me know what you think, and if you would like this new form that I'm going to be featuring in all my all the rest of my videos, you can find them in Buy Me a Coffee. I'll see you in the next video. Bye.